All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is August 27th, 2026. And our top story this morning, it is Nvidia earnings. Another huge beat for Nvidia. Surprising absolutely nobody. The stock is up this morning. Big revenue beat, $96.2 billion versus expectations of 92.4. Let's take a minute. 96 billion in 3 months. That is a huge amount of revenue, of course, with all kinds of asterisks attached. EPS of 222, or should I say adjusted earnings per share, 222 versus 209 expected. Beat on the top, beat on the bottom line. Data center revenue of 89 billion. That was more than the 85 the market was expecting. That is now 93% of Nvidia's revenue is coming from data centers. It's one big giant bet on one big giant unproven technology. And the guidance was even better. They're guiding for a range of 105 to 110.1 billion for Q3, the midpoint of which is above the 105.1 billion that the market was expecting. So a beat and raise from Nvidia, fantastic. Hey, let's stop reading right there. Let's just listen to Jim Cramer fawn over him like a schoolgirl at a Beatles concert, and then just mindlessly pile into the stock, right? Let's definitely not read the 10Q. Let's definitely not go beyond the headlines and actually look at the numbers and look at the categories, because silly rabbit, if we were to do that, we might notice things like sequentially revenue rose 14.6 billion or 18%, but accounts receivable rose by 22.3 billion or 55%. All right. And if we bothered to read and bothered to understand what we were reading, we might understand that that looks an awful lot like channel stuffing. That looks an awful lot like early revenue recognition. Their accounts receivable, which is money they have reported as revenue that they have not yet collected from their customers, went from 40.7 billion last quarter to 63 billion this quarter. So most of that revenue they just reported, they don't actually have it yet. It's just sitting in an IOU column. And that IOU column is growing 3 times as fast as the revenue is growing, which means this lie is getting bigger and bigger every quarter. It's growing further, faster, and further. That's a huge issue. And nobody asks him about that. Jim Cramer doesn't ask him about that. Hey, what's up with 60 days sales outstanding, up from 45 last quarter? Nobody asks about that. Jim, why don't you ask Jensen, why is it taking your customers longer to pay you? And also, maybe we should ask, how are those customers paying you? Because none of those customers make money. If we look at things like purchases of debt and equity investments in Nvidia's earnings, last quarter, the previous quarter, they bought $28.3 billion worth of equities, shares in their own customers, or debt, bonds from their own customers. In other words, they gave money to their customers so their customers could give it right back to them. So last quarter, $28.3 billion. This quarter, $64.18 billion. Whoa. That's a growth of 35, almost $36 billion, 126% increase in purchases of debt and equity securities. That's the round tripping gimmick. That's the accounting fraud right there. So look, take this all in context. What is Nvidia earnings actually telling us? Hey, we're making a boatload of revenue. The only problem is it's early recognition of revenue from customers who are taking longer to pay us. And when they do pay us, they're paying us with our own money. Everybody seems to be forgetting that. But nah, bro, just trade the headline number and hope for the best. And again, after this bubble burst, which is not today, again, it's definitely not today, but after this bubble burst and everybody's pointing fingers and everybody's cracking jokes about, oh, it was such a fraud, it was so obvious. Well, if it was so obvious, how come none of you are talking about it now? Remember, there's like maybe 5, 6 guys in the freaking world who are bothering to look at this. None of them get airtime on Jim Cramer's show. Also going on this morning, that other scam that isn't happening, right? Jensen Huang said this isn't happening. We've got another firm is being probed by the U.S. for smuggling Nvidia GPUs. This time it is Apex Logistics has been accused of smuggling GPUs and servers containing Nvidia GPUs for Supermicro. Ready for this? From Taiwan to Singapore to China. Oh, isn't that exactly what Jack and admittedly Kakashi was the first one to really point out? Hey, the explosion of sales to Singapore ever since it became illegal to sell the chips to China. All of a sudden, Nvidia is selling double-digit billions of chips to Singapore, and it looks an awful lot like they're just smuggling them into China from there. And then shortly after Kakashi starts pointing that out, Nvidia stops reporting geographic sales, the destination. What did they come up with? Sales by customer headquarters, geographic location. They started changing the way they reported every quarter to hide all the chips they were selling to Singapore. Yeah, we've got another company that's under investigation for that. That's after the co-founder of Supermicro got indicted, along with several other Supermicro and Nvidia employees. And also, speaking of the whole round tripping thing, Nvidia also this morning is in talks to buy Hugging Face for up to $13 billion. That's another one. Nvidia bought two other of their customers earlier this week, right? They acqui-hired all the people at Poolside, and they're buying Perplexity, or making a big investment in Perplexity. Now Hugging Face. Remember the expression, you are the egg man, or you are the egg guy? Does anybody remember that? Sooner or later, like if you keep buying up all of your customers, eventually you have no customers left, just yourself, which Nvidia has no problem reporting revenue for sales to itself, apparently. So good luck with that. Now, on to the other issue that is getting just snowballing out of control. This thing that's going on with insurance and this Mark Walter guy, the former owner of the Lakers and the Dodgers. Yesterday, we talked about how LeBron James was mixed up in it in his securitized endorsement deal with Nike. This morning, it's Magic Johnson. No, not Magic. Oh, come on. 6'9" point guard, the most beautiful passer I've ever seen in the NBA, except for maybe Jason Williams. Oh, not Magic 2. Yeah, Magic 2. Equitrust was the name of Magic Johnson's insurance company. He bought it from Mark Walters. Mark Walters ran it, and you'll never guess what Equitrust invested their clients' money in. Well, all of Mark Walters' customers and all of Mark Walters' other investments, and also Magic Johnson's own hedge fund. Oh, great. We got to talk about this one, guys. Oh, this is just gross. Not Magic. And we've got this other guy, too, another insurance company run by a guy named Todd Bowley, Security Benefit Life. They are now caught up in this insurance scam, fraud, investment, whatever you want to call it. Todd Bowley is actually co-owner of the Dodgers and the Lakers with Mark Walters. They do a lot of business together. So we've got another insurance company, two more insurance companies, one owned by this other co-owner of Walters, the other one, Magic Johnson. Why does it have to be Magic? Oh, we've got Meta with their $18 billion slap on the wrist that's their settlement with the DOJ for all the harm and addictive product that they've issued and hurt little girls and caused all kinds of psychological trauma for an entire generation of kids. $18 billion is the cost of doing business for Meta. That's the fine that they're going to pay. But there's riders attached because they're admitting no wrongdoing. They're not going to change really what has everybody so upset. And a major portion of this $18 billion settlement is contingent upon TikTok and YouTube voluntarily doing the same thing, which means it's probably not going to happen. It's almost like the DOJ wasn't serious about prosecuting this problem. We've got the U.S. Army has paid out $2.2 billion to 5 companies to build micro-reactors at U.S. Army bases on what I consider an overly ambitious timeline. That's interesting because the Army hasn't operated any nuclear reactors since the 1970s, but they're going to get them designed, built, and switched on in the next year, 2 years. Good luck with that one. We've got China has just made a major fertilizer sale to India. Now, that is important because India is a major agricultural exporter, and also China had previously banned exports of fertilizer after the start of the Iran war. So the fertilizer is starting to flow again. That is a good sign. But one thing that isn't flowing is natural gas. We got to talk about this Reuters article from Qatar. I've talked a lot in the last couple of weeks. There's been a lot of stories about the oil getting out of the strait, oil tankers running the blockade, and millions of barrels a day of oil is getting out. But you know what's not getting out is the natural gas. We talked yesterday about how that's causing problems in Europe, about how the Netherlands has not made their natural gas storage targets, so they're unprepared for winter, and how interest rates in European government bonds is now tracking the price of natural gas. That's actually the biggest input to inflation in Europe. Everybody's worried about the oil. Maybe they should be more worried about what's going on with gas. Stick around to the end of the show for that one. But first, we must shrink my big melon of a head. Let's see what's going on in the world of finance. Don't forget that like button and that subscribe button for the YouTube algorithm, because we do this one every day, so you can come back tomorrow, have your coffee with the melon heads. And right now, the market is having kind of a muted reaction. You'd think the market would be ripping on those Nvidia earnings, but it ain't. It's up about 30 points or 0.37% this morning. The Dow is actually in the red here, down 49 points or 0.08%. And the NASDAQ is higher by 255 points, 0.87%. So the tech stocks are doing well this morning. Looking over at the U.S. dollar, it is 99.09 for the Dixie. That's off by 7 basis points. You may notice that one dropped off a little bit right about 9 a.m. I'm not sure what triggered that one. We'll have to go back and look for that. Looking over at the bond market, we've got very little movement, especially on the long end of the yield curve here. 5.185 for the 30-year Treasury, unchanged for the morning. The 10-year yield is at 4.660. That's lower by almost a half a point. The 2-year yield is at 4.215. That's lower by almost 1 point. And the 1 month is unchanged at 3.705. Very quiet in the bond market this morning. Some might say too quiet. Looking over at commodities, we've got spot gold's a little bit lower, about $10 here, $4,584 for spot gold. We are below 4,600 after very briefly flirting with 4,700, down by 0.25%. Spot silver is at 68.16. That's higher by a couple of pennies, now lower by a couple of pennies, pretty much going nowhere here. $68 even for spot silver. I like the shiny. We've got copper is lower by about 0.5%. Platinum is off by about 0.8%. Palladium is lower by 1.3%. And crude oil is ticking a little bit higher this morning. It's up 50 cents or 0.62%. $82.75 for October WTI futures. That's up by about $2 from this point yesterday. Seems like oil started to catch a bid midday yesterday. Looking over at Bitcoin, we've got Bitcoin is higher by $90, essentially unchanged this morning, $79,104 for Bitcoin. It's been pretty much stuck in this range for the last couple of days after peaking on Tuesday. All right, but here is the main story of the day. Nvidia tops Q2 expectations on revenue of $96.2 billion and offers a strong Q3 outlook. The bubble is going to pop, but it ain't going to be today. Nvidia reported its Q2 earnings on Wednesday, beating Wall Street expectations on the top and bottom lines and providing a better than expected outlook for the third quarter. For Q2, Nvidia saw adjusted earnings per share of $2.22 on revenue of $96.2 billion, which is better than EPS of $2.09 and revenue of $92.3 billion that Wall Street was anticipating, so a beat on the top and the bottom. The company also says it's projecting Q3 revenue of between $105.8 billion and $110.1 billion. Street was expecting, I think this is supposed to say 105.1. There's a little bit of a typo there. But either way, the midpoint of the range they're projecting is higher than what Wall Street was expecting. So it's a beat and it's a raise. Nvidia stock rose more than 7% pre-market trading on Thursday. And then we've got this quote from Jensen Huang. AI has reached its inflection point. Nobody knows what that means, but it's inflecting. It's doing useful work. Okay, maybe some useful work. Its tokens are productive and profitable. Now compute is revenue, Nvidia CEO Jensen Huang said in a statement. All right, first of all, I don't know what compute is revenue even is supposed to freaking mean. And I would also point out that revenue is irrelevant. It's all about profit. It's about, are you making money? Are you taking in more than you're spending? And if you're not, you're losing money. But never mind that. This point right here, its tokens are productive and profitable. And he repeated this, let's just say it, outright bullshit line on his Jim Cramer interview yesterday. No, tokens are not profitable. Literally everybody who sells tokens loses money. So how is Jensen Huang on a corporate earnings call able to say tokens are profitable? Like that right there should be indictable. That is a materially false statement from a CEO of a now $5.5 trillion publicly traded company. And he's saying it both on TV and in an earnings call. I mean, that alone right there should be enough to prosecute this a-hole. I cannot wait. One day, we're going to see Jensen Huang. I don't know if we'll ever see him in handcuffs. We should. But one day, we'll see him hauled in front of Congress at least to account for this. I don't know. But that right there is just a materially false statement. An easily proven false statement. And he's just saying it without fear. Good God. And I got to send a shout out to Ross Hendricks from Porter & Co. Research, who put out this one yesterday, saying there's a few reasons why Nvidia trades at a steep discount to the market, talking about on a forward PE basis, and there having never been anything like this growth at such a scale. Here's a hint. Accounts receivable was $63.1 billion with 60 days sales outstanding, up from 45 days sequentially due to extended payment terms on large multi-quarter agreements with certain investment-grade customers. So supply constrained that customers can't pay their bills on time. Probably nothing. Great point, Mr. Hendricks. Bravo, sir. We're early recognizing revenue from customers who are taking longer and longer to pay us. Those customers, by the way, you notice they're talking about investment-grade customers, but we've talked over the last week about how all of these investment-grade customers, these data center special purpose vehicles and the debt that they're raising, it's being called investment grade, but it's trading at junk grade interest rates, deep junk grade interest rates, and is being marketed to junk bond investors. But the ratings agencies are stamping it investment grade. It's almost like the ratings agencies are not accurately modeling the risk of these instruments and selling them to unsuspecting investors who don't understand what they're buying. And if that sounds a lot like the GFC, well, that's a lot like the GFC. Bravo, Mr. Hendricks. And again, guys, accounts receivable growing from $40.7 billion to $63 billion in one quarter, a $22.3 billion increase, 55% increase in accounts receivable when your revenue is only growing by 18%. That is a huge red flag. It's not the first time Nvidia has put up this red flag. The red flags are getting bigger and redder, and the world just keeps cheering every step of the way. And here's another big red flag. U.S. probes Singapore firm over alleged Nvidia chip smuggling. Alleged. Are we still using the word alleged? Okay, I guess it's alleged. It's alleged that everybody freaking knows what's happening now. The U.S. government is investigating Singapore-based Apex Logistics for its suspected role in smuggling Nvidia AI chips to China, people familiar with the matter said, and what may result in the first action against a transportation company for allegedly participating in the illegal semiconductor trade, which that same Jensen Huang told us a year ago did not exist on a corporate earnings call. Again, he is a lying sack of leather jacket wearing shit. Authorities are looking into whether Apex, a unit of shipping giant Kuhn and Nagel, may have transported AI systems made by Supermicro Computer in violation of U.S. export restrictions. According to the people who requested anonymity to speak about an ongoing legal matter, NVIDIA chips are the industrial standard for training and running AI models, and firms like Supermicro assemble them in servers and are installed in data centers. And again, Singapore-based Apex Logistics. We've been talking about this for years on this channel, that they're smuggling their chips into China by way of companies like Malaysia and Singapore. There's another example of exactly this happening, while Jensen Huang tells us it's all a figment of our imagination, that gaslighting a-hole. And he also said the circular financing thing was all just a misunderstanding and a conspiracy theory. All right, so let's do a little bit of merchandising, shall we? Merchandising, yogurt. Nvidia in talks to buy AI startup Hugging Face. Yeah, if your customers can't pay, just buy your customers. Nvidia is nearing an agreement to acquire Hugging Face in a deal that would value the AI startup at roughly $13 billion, according to news reports. The two sides have held serious conversations about a transaction in recent weeks, Business Insider said. This was on Wednesday, citing, of course, an unidentified person familiar with the matter. A separate report from The Information said that Nvidia had reached an agreement to buy the business for $12.9 billion. Nvidia has made a flurry of deals in the past year. Actually, Nvidia has made investments in some 40 to 50 of their own customers in each of the last 3 years, including a recent $6 billion licensing agreement with startup Poolside. We just reported that 2 days ago. That included extending job offers to most of the company's employees. It also reportedly paid about $20 billion for most of the chip startup Grok. They also made a big investment in Perplexity this week. They backstopped CoreWeave. They backstopped Iron. They backstopped Lambda Labs. You name it. Oh, OpenAI. They took a big stake in OpenAI. They're investing in Anthropic too. Yeah, like just buying everybody. Nvidia and Hugging Face didn't respond to requests for comments. Hugging Face, which makes AI software and hosts it for other companies, was at the center of a cybersecurity incident in which a model being tested by OpenAI inadvertently hacked the platform. The breach raised alarms about the safety of cutting-edge AI technology. So, look, we've got Nvidia, more accounting fraud, another earnings beat, another probe into illegal sales to China, another round-trip finance scheme, all in the same day, and the stock gets higher. Because nobody reads, nobody analyzes. They just look at headlines and they trade on that. Nvidia stock up by 7.4%, $225.24 a share for Nvidia. It's up big. And full disclosure, guys, I am short Nvidia, which means I'm getting my clock clean today. Making a levered bet on when a collectively insane society comes to its senses. In hindsight, that may have been a risky bet, but hey, is what it is. All right, and we got to talk about this one here. Guys, be careful if you own a life insurance policy, a whole life policy, or if you have an annuity or someone you love has either of those things, man, you better look really close at the people that you're dealing with because this story just keeps getting bigger. Magic Johnson's life insurer backed Magic Johnson's investment fund and a Dodgers TV deal. There's Magic and there's Mark Walter. Same cast of characters. It keeps getting bigger. Now, Magic Johnson. This one's from Hunter Brook Research, which, by the way, Hunter Brook is a short-selling research firm. So they typically take short positions in firms like Guggenheim, which they're currently short, before they publish this research. So it's worth keeping that in mind. As prosecutors probe Mark Walter's empire for undisclosed related party transactions, Hunter Brook has found eyebrow-raising transactions at Equitrust, the life insurer that Magic Johnson purchased from Guggenheim. Again, Guggenheim is the firm that Mark Walters was CEO of. A review of primary source documents identified a series of investments and loans linking Equitrust to Johnson's infrastructure funds and his Dodgers ownership stake. The insurer reported the positions as unaffiliated. In other words, Magic Johnson's insurance company was buying investments sold by Magic Johnson's other companies, buying debt from companies that were in his hedge fund or companies that were affiliated with the Dodgers, which was owned by the guy who was managing Magic Johnson's firm. And he lied about it. He didn't disclose those as affiliated party transactions. Last year, as the Fed circled, Equitrust was sold to another insurance group connected to Walter, Amistad, now a focus of the DOJ's investigation. This is important also. Magic Johnson sold the insurance company last year after all of these alleged transactions happened, and he sold it to Amistad, another Walters affiliated entity. But it's unclear whether Johnson is still involved. Amistad's managing founder is Equitrust CEO Eric Holloman, who was previously the president of Magic Johnson Enterprises and is governor of the Sparks. No wrongdoing has been established. Asked to comment, Johnson, Holloman, Equitrust, and others did not reply. And Hunter Brook went into more detail in this Twitter thread yesterday. Equitrust is central to Magic Johnson's fortune. Forbes attributed most of his billionaire net worth to it. He bought control in 2015 from Guggenheim, co-founded and run by Dodgers partner Walter. Guggenheim continued managing its investments. That's important here. Guggenheim sold to Magic, but then Magic owns it, but Guggenheim continues to manage the investments for the insurance company. Hunter Brook reviewed Equitrust's annual statements, insurance filings, and SEC records. They found two notable positions reported as unaffiliated: a $100.5 million JLC fund investment tied to Johnson and Equitrust CEO Eric Holloman. That's Magic Johnson's hedge fund got $105 million from Magic Johnson's insurance company and didn't report it as an affiliated transaction. They also was a $350 million worth of debt from the Dodgers TV company And that Dodgers TV company was owned by Mark Walters, CEO of Guggenheim, who was controlling the investments of this $350 million into the Dodgers TV company. Again, these are affiliated party transactions. This is Peter and Paul selling their clients' money to Peter and Paul's other investments. And by Peter is Mark Walters and Paul is Magic Johnson here. JLC Principals, Johnson and Holman, his longtime business partner and Equitrust CEO, an SEC filing put JLC Funds' first capital raised on July 27th, 2017. 1 week later, Equitrust, then owned by Johnson, invested in the fund. So a week after he started the fund, his insurance company invested in it. Yeah, he's self-dealing big time here. Walters insurers followed. Delaware Life, a focus of the DOJ probe, invested in JLC. A week after Equitrust, its stake was worth $80.5 million as of December 2025. ClearSpring, another Walter insurer under scrutiny, invested in 2020 just over $100 million as of 2025. This is gross, guys. This keeps getting bigger and bigger. More and more people, just please, not Shaq. Shaq, like he's this big monster beast on the court, but when then he talks off the court and he's like this like lovable, gentle giant, please, not Shaq too. I really hope Shaq doesn't get caught up in this. But it seems like everybody in the LA professional sports world is getting caught up in this dirtbag Mark Walters fraud. And here's another one. Todd Bowley, his insurer, vows to slash pile of collateral loans. Another guy affiliated with Walters, another insurance company, and what looks like another self-dealing fraud. Security Benefit Life Insurance. The Kansas-based insurer controlled by Wall Street veteran Todd Bowley said it will restructure its $14 billion stockpile of collateral loans after such assets drew scrutiny from regulators. The company is considering a range of transactions or contemplating using other vehicles to house the assets, according to a letter to investors. Executives said they might also turn to reinsurance or direct risk transfers as they whittle down the pile of assets. So these guys got caught with their hands in their own cookie jars, the cookie jars belonging to their clients, and now they're all trying to scramble to sell those assets to somebody else to get the money back because if they don't, they're probably going to go to jail. The move comes as the National Association of Insurance Commissioners is planning to implement a proposal to tighten capital requirements for collateral loans, which will make it more costly for Security Benefit to invest in such assets. The revisions could adversely affect the company if it were not to take effective management actions, Security Benefit said in the letter. The company expects significant distributions, repayments, recapitalizations, and corporate transactions, all of which would be sources for repayment and reduction of collateral loans. They're jumping through a lot of hoops to try to get people's money back. Walter Bowley rose to prominence by making splashy sports and entertainment bets. The core of his business empire is Security Benefit, a 134-year-old insurance company that sells annuities to retirees and invests much of the cash in assets managed by other parts of Bowley's Miami-based Eldridge Industries. As of the end of last year, collateral loans made up about 25% of Security Benefit's total invested assets, and almost all of them were backed by assets managed by Eldridge Industries. And this guy, Todd Bowley of Eldridge Industries, who's doing the same insurance self-dealing scheme as Mark Walters, he's also co-owner of the Lakers, co-owner of the Dodgers. Basically the same crew. He used to work at Guggenheim also. This story's getting bigger and bigger, guys. This is spiraling out of control really fast. And look, again, if you've got any kind of a life insurance investment, be very careful, guys, and be wary of any life insurance company that was, say, in the last 10 years, acquired by any private equity firm or anybody who used to work at a private equity firm, because I get the feeling that pretty much all of them have been doing this. Meanwhile, Meta agrees to pay $18 billion to settle U.S. lawsuits over children's social media addiction. $18 billion might seem like a lot of money, but it's not for this company. Meta Platforms will pay up to $18 billion over the next decade and strictly limit how teenagers use Facebook and Instagram under an agreement with nearly all U.S. states to resolve claims that it designed those social media platforms to addict children. The settlements announced Wednesday end a federal trial over allegations Meta products harmed children and the company misled public about their safety. 4 of the states, California, Colorado, Kentucky, and New Jersey, were expected to see close to $200 billion in civil penalties. Guys, this could have been a $1 trillion fine, and it was 18 billion bucks. This is a joke what Meta is paying. And for what they did, I mean, they have done irreparable harm to the psyche of an entire generation of young girls. And they knew it was going on, and they took steps to conceal it from the public. Meta will not undergo a fundamental overhaul. The accords represent a sweeping effort to define how it serves young users. The focus on the case was to protect kids. Yeah, okay, blah, blah, blah. Meta agreed over the next decade to restrict teenagers' use of Facebook and Instagram to 2 hours a day and block all usage from midnight to 6 a.m. absent parental consent. These limits could be tightened if social media platforms Snapchat, TikTok, and YouTube adopt similar terms. Meta will also disable most push notifications to teenage users during school hours of 8 a.m. to 3 p.m. and enhance measures to protect children from accessing age-restricted content. The settlement does not require Meta to abandon personalized recommendations or targeted advertising. It also does not address some content researchers found particularly problematic, including posts that made Instagram users uncomfortable with their body image. Meta denied wrongdoing in agreeing to the settlement. The total payout represents 3 to 4 months of profit and about 1 month of revenue for Meta. But it gets better here. Again, they're paying this over 10 years. The settlement includes guaranteed payments of $12.7 billion, with another $5 billion contingent on whether Snapchat, TikTok, and YouTube impose similar protections. Since when does the government allow settlements where the offender only has to pay if somebody else elsewhere takes some action? Where the hell did this come from? This just goes to show you the government was not serious about addressing the problem of kids being addicted to social media, not even a little serious. And look, not that it's the government's job. It's not. It's a parent's responsibility. And as a parent, I can tell you that is a freaking war that I am engaged in every freaking day, because these companies have their hooks in kids, and it is hard as hell to get them out. But this fine is a joke. And even the headline number, 18 billion, it could have been $1 trillion or several hundred billion. It's only 18. And of that, 12.7 is only guaranteed. The rest is contingent upon these other companies, which were not part of the investigation, taking some action that's probably never going to happen. So in other words, this is just the cost of doing business. Doing harm to kids is legal for a fee. Meanwhile, U.S. Army awards up to $2.2 billion to 5 companies to build microreactors on bases. This one's kind of interesting. The Army said Wednesday it's awarding up to $2.2 billion to 5 companies to build and operate tiny reactors on military bases, which it hopes will one day power remote installations. So-called microreactors are tiny factory-built nuclear plants that developers say will be easily transported and generate up to 20 megawatts of power each. The Army believes that developing them through a program called Janus could one day help power remote military installations, such as those in Alaska or on islands. The program has a goal of deploying the first reactor by September of 2028. I seriously doubt that is going to happen. These reactors aren't even prototypes yet. Here are the 5 companies: Antares Nuclear, BWXT, General Atomics, Radiant Industries, and Westinghouse Government Services. You'll notice these 5 names do not include a lot of these startup shitcos that are being run by tech bros that always have special segments run on Bloomberg and CNBC about how we can put a nuclear reactor inside a plane and fly it to an army base, buy my stock. None of them got the money here. This is largely pre-existing giant companies here. The Army did not detail how much money would be distributed to each company, but Radiant said it would get up to $750 million to develop and deploy 15 of its Kaleidos reactors in the program. An Army official said reactors will have to follow all environmental and safety rules that apply to commercial reactors, but added they would be regulated by the Army, not the U.S. Nuclear Regulatory Commission, which regulates commercial reactors. And I don't know how the hell they're going to do that. Maybe they're going to borrow guys from the Navy, but even still, most of these experimental microreactors are fundamentally different from the reactors the Navy operates. So there's no regulator in the world that even knows how to regulate these reactors. The Army hasn't run nuclear plants since the 1970s, and they're saying it's going to be regulated by the Army. Well, who in the Army knows how to regulate a reactor? The whole idea here is at the back end is we want a commercial product, said Jeff Waxman, the principal deputy assistant secretary for the Army for Installations, Energy, and Environment. Radiant's chief commercial officer, Mike Starr, told Reuters in an interview that the Janus Award is key to the company scaling up its business to eventually meet the needs of commercial customers like data centers in about 2030. And this is kind of what pisses me off here. The government is trying to speed up the rollout of these reactors, but they're trying to do it by going around the NRC, because the NRC is a notoriously slow-moving regulator, and they're like that for good reason. But, they're trying to do this for Silicon Valley. And so they're using the DOE, they're using the Army to try to get around NRC regulations. And look, Silicon Valley and nuclear power are fundamentally incompatible with one another. The mantra in Silicon Valley is move fast and break things. And that is the opposite of everything at the core of nuclear training in the United States. Fundamentally incompatible with nuclear power. I hope they roll out small modular reactors. I really do. I think small modular reactors have a lot of potential. That being said, if they cut corners, they are going to cause mistakes, and those mistakes will be all that the lunatics, and the nuts at Greenpeace are going to need to shut down this industry for another 20 freaking years. So do not move fast and do not break things. Go slow. Take your time. Do it right. Cross T's, dot I's, and don't cause nuclear accidents, because you have to recognize nuclear power is special and unique. Good God. All right. Also, China to supply bulk of India's fertilizer tender in major sale. This one's kind of interesting, and I'm going to go pretty quick through this one because you kind of get it all in just the headline. China had previously restricted exports of fertilizer after the start of the war in Iran. They have now lifted that export ban, and they're selling 1.2 million tons of urea to the Indians. Now, that is important because that 1.2 million tons, just that one sale to the Indians, is more than all of the fertilizer exports in China in June and July combined. So some relief of the tightness in the fertilizer industry, and not a minute too soon, because things are shaping up to be pretty rough in the agricultural commodity sector next year. And last one of the day, as war strands Qatari gas for 6 months, U.S. sales rise and European stocks plummet. The oil is getting out of the strait. A lot of it, way more than people realize. The gas is not. And that's a big problem because everybody's paying attention to the oil. They need to be looking at the gas. 6 months into the U.S.-Iran war, Qatar is among the conflict's biggest economic casualties, with its liquefied natural gas exports slashed by 96%, data shows. Saudi Arabia, the UAE, Iraq, and Kuwait have seen their oil exports hit, but nowhere near as much. Qatar has lost $24 billion in gas sales. That's almost 10% of their GDP, by the way, which is about 5 months' worth of income for the country based on 2025 data. Let's see, where do they have it here? While neighboring Gulf exporters have managed to sneak oil secretly out of the Strait of Hormuz, Qatar has exported just 18 LNG cargoes, down from 509 in the same period last year. That's according to data from intelligence firm ICIS. 2 Qatari tankers have been attacked. And there is a chart here. This chart shows, it's pretty important here. This is total U.S. LNG exports. And you can see at the bottom here in light orange, that's exports to Europe. Then you've got exports to Asia in the middle. And you've got exports to other, which I guess South America, Africa, everybody else. Now, what is important? You look, the exports to Europe since the war started have gone down significantly, while the exports to Asia have exploded higher. And remember in that article yesterday about the Netherlands not being able to meet their gas storage obligations or their gas storage target. And the Dutch guy said that it was not commercially viable to meet their target. In other words, the Europeans can't afford the gas. Why? Because Asia is outbidding them for it. And that other article that we saw yesterday was talking about how the German 10-year Bund yield, if you look at that chart and you line it up with natural gas prices, it's trading almost in lockstep. If gas gets more expensive, European borrowing costs go up. So this could translate into problems in the European banking system as well. Everybody's paying attention to oil. The problem in oil, not nearly as bad as everybody feared, but the issue is that's not the real problem. The problem is starting to look more and more like gas, and that could potentially spiral into a debt crisis in Europe. So keep an eye on natural gas getting out of the Strait of Hormuz. That's the problem we'll all be talking about in a couple of months. Everybody, I just want to say thank you very much for having your coffee with the Melonheads this morning. Don't forget the like button, the subscribe button, the hype button, all the good buttons. It really helps out with the algorithm. You'll find all that stuff just below my face here, as well as links to YouTube, Patreon, and Buy Me a Coffee. Thank you so much to all the channel members who support the channel there. Links also down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.